do you have any thoughts on modern monetary theory? And yeah, all right, I see you do. Let's hear. Well, what do you think?
Yeah,
Is
I
that a
do.
viable policy to pursue?
Well, which one? I mean, this raising of interest rates that they're doing now, that's an experiment. The monetary policy that we've had for the last, I guess it's more than 10 years now, has been a new experiment. It never existed before.
The question of
I don't like this world actually. I mean, I think it's very dangerous.
We're very honored to be joined by Dr. Eugene Fama. He is the Robert R. McCormick Distinguished Service Professor of Finance at the University of Chicago Booth School of Business, widely regarded as the father of modern finance. We're going to be talking about his work and some of his thoughts on the current market conditions. Dr. Fama, an absolute pleasure to host you. Welcome to my show. Thank you for being here.
My pleasure.
Dr. Fama, when you wrote the efficient market hypothesis, I believe you had said this in another interview, you didn't expect the paper to be published initially, right? And how did it feel knowing that not only was it published, you won the Nobel Prize for it, and it kind of changed the fabric of corporate finance forever?
Well, you never know which of your research projects is going to get the most attention until time passes and you see what happens. But for this one, other people had said similar things, but I guess nobody quite put it the way I did, so it got a lot of attention. And I think it was mostly the empirical stuff that was in my thesis that got the attention. That was somewhat new. We're going back to the time when computers were first coming online, so anybody that did a big computer project automatically got a lot of attention.
Well, it certainly impacted my life and my my friends' lives as we were students of finance and at the undergraduate level, and it was required reading for everybody. So you indirectly gave us more homework. So thank you for that. but
My
but we
goal in
certainly
life.
we learned a lot. Before we get into the efficient market hypothesis itself, I'd like to just ask you a question, which is probably something you've been asked way too many times in your lifetime over your career, which is that when a fund manager, an active fund manager, does beat the market, first of all, how is it that he's done that? Because I do know that you said in another interview that when an active fund manager beats the market, usually it's at the expense of an active fund manager that is not beating the market. That's just arithmetic. Is it possible to do this consistently? And if so, what does that fund manager have that other fund managers do not?
Well, the fund manager has insights about what determines prices that are better than other people's insights. But the problem is identifying such people. So you can't identify them after the fact. If you go look at people who have done well in the market, you're probably just looking at somebody who was lucky. You kind of have to follow them forward and see whether they continue to do well, and then judge whether they actually have skill. So most of the performance that people measure is actually due to luck, good and bad luck.
Going into your theory now, the efficient market hypothesis states that markets perfectly reflect all information at any given time. There's three forms: weak, semi-strong, and strong. We'll get into the details in just a bit. But Professor Fama, if a fund manager were to have beaten the market, let's say he were to have done that over the course of a certain period consistently, and he tells you, Dr. Fama, I've done that because I've made assumptions about the future that have been consistently correct. It just turns out to be correct. I'm not lucky. I'm just a good forecaster. How would you respond to him?
I'll follow you forward and see if you continue to do it, because that's an after the fact. So if I look after the fact, there will always be winners. There will always be losers, but most of that is just due to chance. So you have to follow them forward and see which ones continue to do it. And even out of that group, some will continue by chance. So you have to. This is a statistical thing that Ken French and I worked on. How do you determine the difference between luck and skill? And we did this for the whole mutual fund industry. And what you see is just a huge range of outcomes by funds over their lifetimes. But it looks a lot like what you'd expect by chance if they were all just had good or bad luck over that time period. There's a little bit of evidence that there is in the extreme tail. There are some people that do have skill, but it's very that's let me be clear. There's some evidence that's true before fees and expenses. In other words, that they can pick stocks after fees and expenses. Very difficult to find anybody that can beat the market. They probably are some. There probably are some. The problem is distinguishing between luck and skill. I don't think that's possible for the typical investor.
Well, let's just touch on that real quickly. You said you've done research on this. What evidence would you have to look at to determine that somebody is skillful rather than just lucky?
You can't do it for individuals. So what we did was to take the whole population of mutual fund managers and say, what would the outcomes for this whole population look like? In other words, all of them. What would they look like if they were just lucky? What kind of distribution of results would you see if everything was due to chance? And it looks very much like the actual distribution. And there's just a little evidence that if you give them back all their fees and expenses, the right tail, in other words, the good tail of the distribution, looks a little thicker than you'd expect by chance. But after fees and expenses, that disappears. So basically, there's not much evidence that investors get better returns from active management.
Certainly, there's the entire passive management industry, one could argue, was spawned due to your research, because I guess people have resigned to the fact that it is not easy or even possible to consistently actively beat the markets over time. And so why not just design an index, or an index fund rather, that just tracks the benchmark? I guess that leads to my ultimate question before we talk about your theory is it possible to consistently beat the markets without it being resigned to luck over an extended period of time, perhaps over a multi-decade career?
Sure, it's possible. Anything's possible. But the problem is identifying that person and distinguishing luck from skill. That I defy anybody to do. After the fact, it's impossible.
Your strong form, the strong form version of the theory states that all information, including private information, is factored into the price. And so even if you have insider information, you can't really beat the markets.
That's an extreme. That's an extreme view. I don't think
you
that's
don't personally. All right.
That's when you do research, you have to start with a model that states things in an extreme way, and then you look for deviations from that. Okay. So that's what's true of that model.
So is it true then that empirical research suggests that the real market performance lies somewhere between weak form and semi-strong?
No, I think it's pretty strong evidence that so you have to, let's step back a second. You can't make a generalization like the one you just made. It's always in the context of some specific test. Okay, so what I can say is that, for example, for the mutual fund industry, where the data are good and you can do a lot of testing, it looks like pretty much what you'd expect by chance, that everything is due to chance. But you can only go as far as what the data you've looked at tell you. I can't say something about the market, because I haven't tested it on everybody, just tested it on particular subsets of people. Mutual funds, a big one. But if I look at pension funds or things like that, the evidence is pretty much the same. Just mutual fund data are easier to get.
Well, okay. Well, let's back up and just maybe for the audience who may not have studied your work or listened to our prior talk, tell us the difference between weak form, semi-strong, and strong form, and we'll get into an application.
Okay, so these are words I don't use anymore. They were on my thesis. We're talking about 1963 here.
They're on the CFA program, Dr. Fama. Everybody has to study it.
I don't know why, but they do. Well, the weak form just says you can't beat the market just using past prices. So like chart reading won't work. The semi-strong form says you can't do it with published information. The strong form says you can't do it with any information. So that's basically what it goes.
So markets are
The strong, the semi-strong form would say public information can't be used to beat the market, but maybe private information can. So maybe the company's insiders have information that the other people don't have. But the strong form would say even that's impossible. Now, I wouldn't go that far because there's lots of evidence that insiders do have information that outsiders don't.
Let's drill a little bit deeper into each form and provide some examples for people to understand. Let's talk about the weak form first. I know that's probably not what you call it now, but going back to what you said about technical analysis possibly not working, that rests on the assumption that past prices or past price movements don't necessarily tell the future, correct? I mean, there's an entire industry of people who use just charts. They don't even, some people, I'm not saying all, but some people don't even know or care to know what stock they're trading. They just look at the charts and they're able to make predictions on or trades on historical price pattern. Is that something you've studied, and how would you evaluate that kind of technique?
It's junk.
Okay.
There's a famous story about that. Holbrook working, who I think there was Holbrook working, who was an economist at Stanford, went to the faculty lounge and he had a picture, a graph, and he said, here's the behavior of the prices of some agricultural commodity over the past X years. What do you think? And immediately his colleagues said, well, here's this period of time, here's that period of time. And they came up in no time at all with theories about what it was and how predictable it was. And he said, well, it turns out these are just accumulated random numbers. So this is just a random walk. And you're seeing all kinds of patterns in it that don't really exist. They're just due to chance. And that's basically what chart rating is about.
How would you evaluate certain theories about waves and recurring patterns, such as the Elliott wave theory, or the theory or hypothesis that all prices eventually mean revert? If you're a certain standard deviation above the mean for a certain amount of time, it's eventually going to mean revert downward or upward.
That's a claim. That's a testable claim. I would like to test. You'd have to be specific about the prediction, and then you could test it. But I wouldn't believe it until I saw the test.
Let's talk about fundamental analysis. It's interesting how there's a whole industry around value investing, but if markets are purely efficient, then what is the point of having valuation indicators, price to sales, price to book?
So you would have to say that there are two dimensions of expected returns. One is whether the prices are set properly, and the other is what determines expected returns, the expected returns to get investors to hold the securities. So investors won't buy stocks if the expected return is zero. They're going to need some expected return that's commensurate with the risk that they take. So that's the other half of the story that's difficult to nail down. You need some theory about what does a market equilibrium look like in terms of expected returns? How do you measure risk, and what's the relation between expected returns and risk? So that's the whole area of asset pricing is basically around what kind of models do we need to define risk and examine the relations between expected returns and risk. And if that model is correct, how will prices behave? That's market efficiency added on top of that model. So I kind of pointed out in my first stuff 100 years ago that this was the conundrum of market efficiency that had to be tested in the context of some risk return story, and that made it very difficult. So these are the two parts that you would have to test. So the question you're asking is, does a risk story say something about market efficiency? Well, it doesn't. So if value is a dimension of risk somehow, then it can be compensated in expected returns. Value stocks, for example, tend to be poorly performing companies. They tend to be poorly performing companies. If that's a dimension of risk of concern to investors, it could well be compensated in expected returns.
Are you sorry, Dr. Fama, are you suggesting that value stocks should have a higher risk premium?
I don't know. We suggested that as a possibility. Documenting that it's true So this is the problem with this kind of thing. It takes basically a lifetime of data to say something solid about expected returns. So you can't just, 5 years is nothing, 10 years is nothing of stock market data. So I can't really say whether it's a risk factor in expected returns. It's shown up in the past as being something that can't be explained by some popular asset pricing models, but that doesn't mean it's necessarily an ingredient of a new asset pricing model.
Does the size and liquidity of a stock affect how much public information is absorbed into the price?
That's a popular idea. It has never been documented. So a popular idea for another variant of that is, have markets become more efficient because information is so easily available now and available so quickly and so cheaply? And there's really no evidence that the evidence is that markets have always been pretty efficient. We can't tell whether they got more efficient as a consequence of more and better information, faster, available more quickly.
Certainly now you have not just more information than perhaps when you first did the study, but you have more market participants.
Right.
Whereas before, trading and investing may have only been accessible to institutional traders and investors and perhaps a few retailers on the outliers. But now you have an entire new demographic of traders using low-cost trading platforms online, people who have previously not have access to the markets. Do they alter any form of efficiency in the markets?
That's an excellent question. And there's no research documenting it one way or the other. So it could be the case that they make markets more efficient. It could be the case that you just get more dummies in the market and they make the market less efficient. It becomes more difficult to make the market efficient. And nobody that I know of has come up with a test to tell me which way it goes.
How does your theory then explain irrational market behavior? Let's take the example of dummies, for example. If they all herd into a specific stock with no other reason than the fact that they like that stock, as we've seen on the internet, they're called meme stocks. I mean, how does EMH explain that behavior?
It doesn't. So the irrational behavior definitely exists. Its effect on prices is something that you hope is exceptional rather than the rule. So there are clearly cases, where lots of people jump in on a very small stock and they push its price up for a while, and then it comes down and crashes. So you can think of that as a market inefficiency. So there are examples of things like that do happen, and I think they're more likely to happen the cheaper that trading gets and the more people get into it. But I think they're the exception. They're not the rule, hopefully. Because if they become the rule, then capitalism is doomed.
Wait, what? What did you mean by that? Why is capitalism going to be doomed?
Well, if prices are no good for allocating resources, where does capitalism go in that case? That's the basis of capitalism, is that prices are good signals for resource allocation. But if they aren't, we're in trouble.
Well, okay, so let's suppose a black swan event were to hit the economy. Would there be a window of time between when the event happens and when the information is priced in, during which that window probably would be the optimal window to make a trade?
Well, you'd have to look. My thesis actually was on events like that. So basically, the fact that the distribution of stock returns is way too fat-tailed relative to a normal distribution. There are too many big returns and too many small returns to be explained by a normal distribution. And there's no evidence. So actually, with three of my students, I did the first so-called event study where we looked at the adjustment of prices to the announcement of stock splits, and the adjustment was basically instantaneous, and there wasn't any lag. And there have been thousands of such event studies done since then. And they generally come up with that result. So they can't find evidence that it takes a while for these things to to adjust. In most cases, the adjustment happens very, very quickly. If it happens slowly, that'd be a profit opportunity for somebody to come in and trade on it. But the existence of profit opportunities tend to erase them because people do jump in then.
In your research, how long does it usually take for information to be priced in?
That's a general question. I can only answer it in the context of what has actually been tested. So for the stuff that's been tested, it's basically instantaneous.
Based on your theory, then, would the best move for an investor over the long term just to buy a low-cost index fund?
Just to buy and hold, basically. Unless they get out of whack in terms of risk and they want to rebalance, but basically they shouldn't be trying to predict the market or individual prices. They should just be diversifying and put it in and let it run.
Has there been any evidence to suggest that value beats growth stocks or vice versa?
Well, over the historical period from 1926 to maybe the last 10 years, value stocks did better than growth stocks basically around the world. But that reversed the last 10 years. But the problem with that is, as I said earlier, 10 years really isn't enough data to say anything solid. So maybe the value premium has gone down. Maybe it doesn't exist anymore. But we don't have enough data to tell.
I'm curious as to whether or not you think the advent of artificial intelligence is going to change asset pricing or even the asset management industry. When you have a computer that's advanced enough to process millions, perhaps even billions of data sets instantaneously, and make an investment decision based on information that no one human could have at any one given time, does that change, first of all, anything in your model? And second, does that change ultimately the nature of the asset management industry?
Well, somebody has to write that program, that AI program. And that program has to have built into it a way to tell which things are underpriced and which things are overpriced. So that presumes the existence of such talents. Now, I don't know why, if I had those talents, I don't know why I'd ever put them into a program that everybody would have access to. I think I would use them myself.
Well, let me ask you this then. Hypothetically, you don't have to give all the details away if you don't want to, but if you were to design such a program for yourself, what are some of the what does this program need to be able to do? What information do you need to feed this program in order for you, as an investor, using this program to beat the markets?
Better predictions of the future. That's the bottom line in all of this. But I don't know how you do that with just how a programmer would, or even a massive programmer would sit down and write a program to do this, to predict the future. There are too many random variables in economic results to do that. At least in my opinion, at this point in time. Who knows? I mean, I'm not an expert in artificial intelligence, or I think I am. I think it's all around me, actually. Artificial intelligence, mostly the active management industry.
Well, all right. All right. I want to move on and talk about some current events. I mean, I think we talked about this briefly last time we spoke, you and I, and we talked about how inflation is worrying for you. Do you have any thoughts on modern monetary theory? And all right, I see you do. Let's hear. Well, what do you think?
Yeah,
is that a viable policy to pursue?
Well, which one? I mean, this raising of interest rates that they're doing now, that's an experiment. The monetary policy that we've had for the last, I guess it's more than 10 years now, has been a new experiment. It never existed before, where the Federal Reserve's balance sheet got so huge, and where they started to pay interest on reserves, because otherwise the banks wouldn't hold their reserves. In the old days, we said the money supply, the basic money supply that determined inflation was the monetary base, which is currency plus reserves. And the Fed does control that base. Or it did in the old days. and reserves did not pay interest. So there was an opportunity cost to holding them. Banks didn't want them unless they really, really needed them. But now we have several $1 trillion worth of reserves out there, and they pay interest, and they're freely exchangeable for currency. So it's not clear how inflation gets determined in that world. What stops it? I'm in finance, so most of the people in macro don't think like people in finance. In other words, they talk about the interest rate. There's no such thing in finance. There's a whole range of interest rates, and there's a whole range of risk premiums that face firms making their decisions. So the issue is, for example, the Fed raises the federal funds rate now. It's pushing it up, pushed it up now. It's above 4%, I think. So that's the overnight rate on risk-free loans. Basically government debt. The Fed reserves are basically government debt. So that's the overnight rate on government loans. Whose cost of capital is that? Nobody that I know. So why should it have a big effect on economic activity or inflation? I don't know if it will or not. I don't think we have a good model for that. I haven't seen one, and I know all the pretty good people in macroeconomics. So they have models, but they strike me as being toy models because they always talk about the interest rate. There's no such thing.
Well, doesn't the overnight rate, Dr. Fama, affect all other interest rates?
I did a paper on that, actually.
Oh, really?
The effect kind of peters out after about 2 years. So beyond 2 years is no noticeable effect. But it peters out before that. I mean, it's losing its ability to push those rates slowly but surely as the maturity lengthens. So even if it go out 2 years, whose cost of capital is the 2-year interest rate? Nobody's.
Going back to modern monetary theory, it's the idea that the government, that the Federal Reserve, can increase the money supply without any consequence to inflation. Is that a theory that you've analyzed, or is there any empirical evidence to suggest that it's true?
Yeah. Well, the old theory I would have accepted when it was the case that there was a well-defined money supply, which was the monetary base, in my view, which is currency plus reserves. But that was in the world where reserves did not pay interest. Now that they pay interest, the monetary base has lost its meaning. So I don't know what determines inflation. Let's put it this way. I don't know how you control it. I don't know how you control inflation in that world.
There are several monetarists, including Alan Greenspan, who may have believed that to control inflation is to control the money supply, which is to bring down the empty money stock. The growth would change inflation rate, no?
No, Greenspan knew that when he talked about the money stock, I think he knew that meant the base, the monetary base. The money stock is not defined anymore now that the reserves pay full interest. It's just part of normal security. Normal security is outstanding. So you have currency, that's still money, doesn't pay any interest. But reserves pay full market interest. In fact, they push the interest rate on them above the market. I don't like this world, actually. I mean, I think it's very dangerous.
What's dangerous about it, Dr. Fama?
I mean, I'm not convinced that they have any control over inflation. So when somebody asks me what determines inflation, I say inflation is what it is. I don't think anybody has any control over it anymore.
The question of how to solve our inflation problem or a future inflation problem is a hotly debated topic amongst academics and researchers and industry professionals. How would you respond to the fiscalist school of thought, which is that taxes have a direct impact on inflation? Is that something you've observed?
The fiscal theory says you have to combine, I think what it says is, you have to combine the fiscal activities of the government with the monetary activities of the government, and that will tell you where the money supply has to go in order to clear all the books of the government and the private sector. So it's basically saying, if you don't raise taxes, you're going to start printing money. But I'm not sure I buy that. But
Dr. Fama, I'd like you to comment on the risk of the dollar collapsing, which is a rhetoric I've been hearing on the news a lot. And there's two arguments that I've heard regarding this topic. The first is that there's a de-dollarization trend happening, which is to say that other countries, other major economies around the world have been or are starting to trade amongst themselves using another currency that is not the US dollar. We're starting to see, for example, countries trade oil in another currency that's not the US dollar. In other words, the petrodollar is being phased out. And this could pose a risk to the US dollar's status as the sole reserve currency. Now, the second argument for a dollar collapse is that the Federal Reserve has simply printed too much money, has created a large enough balance sheet that will warrant perhaps a hyperinflationary scenario down the line. And so hyperinflation or even just very high inflation will eventually erode the dollar's value. How would you evaluate these arguments?
Yeah, so the latter one would have been true if they never paid interest on reserves. So if they just put out $2 trillion worth of reserves and didn't pay interest on them, then we'd have hyperinflation. But they didn't. They put the reserves out and they knew they had to pay interest on them if they wanted them to be so big. So that one went by the boards when you started paying interest. But what happened with that was you couldn't control inflation with the monetary base anymore. You had to have something different. And they're betting that fooling around with federal funds rate will do the trick. And I'm not at all convinced that that's true. Now, there was a second part of your question. I forgot.
Yes, the first theory was that as the dollar loses its status. Well, first of all,
wait, that's a good one. There's so much misunderstanding of that it's kind of laughable. So here's the misunderstanding: the dollar is not the international currency; it's the international unit of account. You use both of those terms. Those are two different things. So when I say it's the unit of account, all that means is prices for international trade get stated in dollars. But people aren't transacting in dollars. They're just stating prices in dollars. Then they settle in something else. So people aren't holding tons of dollars in order to do their business. They're just stating prices in dollars and then exchanging some other claims to clear the accounts. So whether or not your currency is the unit of account, I can't see that's important for anything. The currency that wins that game tends to be the one that's most stable in terms of real value. So if we're stable in terms of real value, we'll win the game.
When you see headlines like Saudi Arabia selling oil or perhaps other goods to another country in another currency that's not the US dollar, in other words, right, they've stopped using the petrodollar. When you see headlines like China and Russia trading amongst themselves with using the Chinese yuan, does that have any impact whatsoever on the strength of the dollar going forward?
No. The Chinese and the Russians are going to trade the same things no matter what prices they state them in. So if they state them in dollars, they're still going to trade in whatever the Japanese, I can never remember the word for the Japanese.
Yen, yes.
No, yen is Japan, so.
Yes.
Ringer or whatever it is. I don't have any, I know that. What the ruble is going for these days. No, they're gonna state prices, and the Chinese probably don't want things stated in ruble in any case because it's too variable. But it's the difference between a unit of account and something that you actually take in exchange. The dollar is not taken in exchanges; it's just prices that are stated in terms of dollars.
The other concern I've heard amongst some academics is that, as you see over the last couple of decades, the U.S. dollar roughly, in the past, accounted for roughly 80% of global trade, which is to say that 80% of global trade was denominated in U.S. dollars. That's come down to about 60. Let's assume this trend were to continue and it goes down. Is that an indication of American power, both militarily, politically, and economically?
No.
So you see
it's an indication that prices in dollars are stable. So it's cheap it's efficient to quote prices in a unit of account that's stable in terms of real value. That's all it says. Doesn't say anything else.
Okay. Because there's been a lot of concern again of people saying that, well, I should sell my U.S. dollars now because there should be another currency in the future, in the distant future, perhaps that could challenge whatever that means, rival the U.S. dollar in hegemony. Is that? Can you evaluate that investing idea?
I can say it doesn't matter. It tells you whether if the dollar loses its place as the unit of account, what it says is somehow its real value got too variable, and people didn't want to use it anymore. So there's always competition between units of account for being the king of how people state prices. But that doesn't mean that has any benefit to the country that wins it, except it does say their prices are probably the real value of that currency is probably pretty stable. People aren't actually holding that currency, they're just quoting prices in it. So, for example, when Israel was having a hyperinflation, they started quoting prices in dollars, but they weren't trading dollars, they were trading in their local currencies, or they were actually probably doing a lot of bartering. But the dollar was the unit in which they were stating prices. But they weren't actually trading dollars.
Some people have said that one way to fight inflation is to anchor the currency to some hard asset. In other words, a return to the gold standard doesn't necessarily have to be gold. It could be a new digital currency, for example. Is that a theory that you subscribe to?
The dollar is a digital currency.
I'm talking about, let's say, Bitcoin. But
Bitcoin. Well, that's a totally different subject, actually. Which one do you want?
Let's talk about gold first, because there's natural history.
Gold. The price of gold is too variable to be to say price. The price of gold has gone all over the place in the last 25 years. So that clearly is not going to be a good unit of account. So you're going to want something that has a stable price.
What if we fix the price of gold again, which was what happened during Bretton Woods?
You're not going to be able to do it, I don't think.
Okay.
But I mean, who knows? But I mean, I don't think you can do it. You're not going to go back to $32, that's for sure. Because then you'd have massive deflation.
You're going to have massive deflation, is that what you said?
Sure, if you could get the price of gold down to $32 somehow, then all prices get stated in terms of that. So somehow you have to have a big deflation to get there.
All right. So bottom line, you don't think the U.S. will ever hyperinflate to the extent of the Weimar Republic, let's say?
Well, who knows? I mean, who knows? We're running huge government deficits. Are we going to pay them back by raising taxes, or are we going to pay them back by somehow devaluing the value of the promises? And that's inflation. That's the fiscal theory, by the way. You got to pay your bills either by taxes or by inflation.
Which is better?
It depends on what you're holding.
I have a final investing question, and then I have a fun question. Some people, economists, whether or not they're right or wrong, is a different story. But some people are projecting a recession to hit our economy soon, if not already in a recession. Do you know any strategies over the course of your studies and career with which you can beat recession? That is to say, certain types of stocks or indices or sectors that have consistently done well during periods of economic contraction?
I don't know of any, but that doesn't mean it's not true. I just have never studied that topic.
Okay. You told me offline, last question, you told me offline you're mentoring and teaching a group of graduate students. What are some of the most interesting thesis ideas that have been proposed to you?
Oh, I don't know. They're only in their third week, so they're kind of still floating around. Ask me again in 10 weeks, and I'll tell you.
All right. Any advice to a young student learning economics? I remember when I was in undergrad, I hated the math, but
well, I was a language major in college, so I'm a village idiot as far as math is concerned.
I think Eugene Fama calling himself a village idiot is probably this the irony of the century. Would you recommend a student, let's say today, to study? What would be if somebody wants to be successful? Okay, whatever that word means. He says to you, Dr. Fama, I like to go to college. I like to study something. I want to make a lot of money. I don't know what I want to do with my life. I just want to make a lot of money. What would you say to that person?
Well, I don't think I think studying economics is a good start. Uh, here's the best thing though. Find something you love to do. This is the advice I give to young people that want to get rich. Find something you love to do, and make sure not too many other people want to do it. Because don't tell me you want to be a ballerina, because too many people want to be ballerinas. So you could be very, very good, but you're not going to make a lot of money. But tell me something else that not a lot of people want to do that you love to do. That's where you should go. But I can't tell you what that is. That's a personal decision.
Have you always loved economics, or is this a profession
I didn't know about economics. So I had never heard in high school or up into college. I had never heard about economics. So I intended to study languages and become a high school teacher and a sports coach. And then I took an economics course in my junior year in college, and I loved it. And I immediately switched to economics as a major thing I was studying in my last 2 years. And I've been doing it ever since. So
actually, I think you've stated before that when you first started doing research in corporate finance, it was a relatively new academic field, was it not? What was your impression of this discipline, and what do you think it needed more of?
Well, there wasn't any. It didn't exist basically. So academic finance didn't exist. Harry Markowitz wrote the first asset pricing book. It was his thesis in the economics department in Chicago. It was portfolio theory. And I don't think there was anybody there that could help him with him. He did it all on his own. And Miller and Modigliani started off corporate finance at around the same time, the late 50s, early 60s, when they came up with the famous Modigliani-Miller theorems. And then, the efficient market stuff came around in the early 60s, and then option pricing in the early 70s. And, since then we've been kind of developing all of those themes in a hot and heavy way. So there's much more stuff available now. Basically, when I started it was like shooting fish in a barrel. There wasn't much research of any merit that had been done in finance before that. So it wasn't that I was a genius or anything. It was just that people weren't thinking in those terms at that point. I happened to get exposed to people like Harry Roberts and Merton Miller who were interested in it, and they gave me a lot of help to get going. So there are a lot of other people that deserve any success that I've had in my career.
Well, Dr. Fama, I appreciate your time today. That was a very generous use of your time. Thank you. And thank you again for all the work that you've done and your contributions to corporate finance. Our industry would not have been the same without your work. So thank you again.
My pleasure.
And we'll speak again soon. Thank you for watching my show, and please subscribe.
Okay.